When you think about the stock market, what's the first thing that comes to mind? For a lot of us, it's probably a scene just like this, that chaotic, loud, high-energy trading floor of the New York Stock Exchange. People yelling, waving papers around, making split-second deals. It's exciting. But is that what it's all about? Is that what it really means to put your money in the market? Well, here's the thing. Even though both involve buying and selling stocks, the practice of trading is worlds apart from investing. So let's really unpack the difference.
All right, to get to the bottom of this, we've got to start with the basic definitions. Now, you'd think a dictionary would clear this all up, right? But honestly, the official terms are a big part of why people get these two ideas so mixed up in the first place.
Okay, let's start with investing. The technical definition is just incredibly broad. It's just spending money with the hope of getting a return later on. I mean, by that definition, almost anything could be an investment, right? Buying a stock, buying a house, it doesn't give us much to work with.
And then you have trading. Its definition is just as vague, simply the act of buying or selling investments. So wait a minute, an investor who decides to sell a stock after 10 years is technically trading? You see the problem? The literal definitions really don't help us tell these two philosophies apart.
So here's the real deal. The crucial difference isn't in the dictionary. It's all about the goal. Think of it this way. An investor is planting a tree. They're hoping to profit from its slow, steady growth over many, many years. A trader, on the other hand, is trying to surf the waves of the market. They're trying to profit from the quick ups and downs. One is about gradual appreciation. The other is all about cashing in on price swings.
And that core difference in philosophy, it leads to two completely different ways of operating. The two places you can really see investors and traders split are in their time horizons and the way they actually analyze a stock.
First, let's talk about timing. And I mean, the difference here is just massive. It's night and day. An investor is in it for the long haul. We're talking 5, 10, maybe even 30 years or more. They're betting on a company's success over time. Trading, though, that's the fast and furious approach. We're talking about holding a stock for a few weeks, a few days, or in the case of day trading, not even overnight. Some of these trades literally last for just a matter of seconds.
Now, to understand the second major difference, how they analyze things, you have to get your head around this one central concept. A stock has a price. That's what it's selling for at any given moment. But it also has a theoretical intrinsic value, what you might call its true worth, based on the company's actual health and profits. And here's the key. Those two numbers are often not the same. That gap is where both investors and traders find their opportunities.
This table breaks it down perfectly. Investors are zeroed in on that intrinsic value. They use what's called fundamental analysis. They're digging into the company's finances, its leadership, its place in the industry to figure out what it's really worth. Traders, on the other hand, are pretty much only focused on the stock's price and how it moves. They use technical analysis, studying charts and patterns to try and predict the next short-term swing. A successful trader could buy and sell a stock without even knowing what the company actually does.
So you can probably see why trading might seem so exciting, right? It's fast, it's competitive, and the stories you hear are always about these quick, massive wins. So let's talk about that allure, and then contrast it with the stark and often unspoken reality of it all. I mean, the appeal is powerful. You see those ads online of people next to a private jet talking about some simple trading strategy that made them a millionaire. It sells this dream of a high-stakes game where you can go from zero to hero in no time. That fast pace and the thrill of a quick profit is a really seductive promise, especially for younger folks just getting into the market.
But, and this is a huge but, that promise comes with a massive catch. Trading is an incredibly high-risk game. Because the profit on any single trade can be tiny, traders often have to use huge amounts of money, sometimes even borrowing it, which just dramatically magnifies their losses when a trade goes wrong.
And for the average person trading from home on their laptop, let's be honest, the deck is seriously stacked against you. You're trying to make these rapid-fire decisions with incomplete information. And who are you competing against? You're going up against industry professionals with massive amounts of money, the best research, and super-fast algorithms that can execute trades faster than you can blink. It is just not a fair fight. It really helps to think of trading like playing a game of poker. Yeah, you can be really skilled at it, and a very small number of people do make a living from it. But there is a huge element of just pure chance involved. And when you're at a table with seasoned pros who have way bigger bankrolls than you, the odds are just not on your side. So, after looking at the philosophies, the methods, and all the risks, what's the verdict? Which path makes the most sense for the average person who's just trying to grow their money for the future?
The conclusion is pretty clear. For the vast majority of us, long-term investing is the most reliable path to actually building wealth. By focusing on the long term, you're betting on the broad, steady growth of the entire economy. And that's a much, much safer bet than trying to guess these unpredictable short-term swings.
Sure, investing doesn't have that same adrenaline rush as a big trade, but maybe that's a good thing. After all, if what you're really looking for is the thrill of high stakes and pretty bad odds, you might as well just go to a casino. At least there, you might get a free drink.
Ultimately, the final question is one you really have to ask yourself. When you put your money into the market, what is your true goal? Are you strategically trying to build a financial future? Or are you just looking for the thrill of a casino? Your answer will tell you everything you need to know.